Mr. Burnfin is a member of the COBAC Advisory Board, the Albany chapter of Georgia Society of CPAs, Artists in Cities, Sortoma Club, and Leadership Albany class of 2023. He is also the speaker at our recent GSW TEDx event. So today he'll be sharing some insights from his career. So let's give him a warm welcome.
Yeah, the TEDx event went not as planned. I spent the week before that in the hospital. So I cut my knee and it got infected and I just ignored it for too long. And so I got to the hospital the day before the TEDx event. So I didn't know my speech, didn't have it memorized the way I would have liked to. But yeah, thank you for the introduction. She said I went to GSW from 2011 to 2015 and really enjoyed it here. Graduated in 4 years, which was a miracle. But yeah, I played baseball for a couple of those years. And so after I graduated, do I have a clicker or no? It's okay if I don't. But yeah, after I graduated, I went to Kennesaw State and got the extra 30 hours I needed to have 150 to be a CPA. And I studied for the CPA exam while I was in grad school. And that was really helpful because you're staying in the process of studying, like you're starting school, and then you study for the CPA exam to go hand in hand. And it's really tough to do that whenever you're working. And let me just say too, if y'all have any questions or want to interrupt me, please feel free. But after I went to Kennesaw State, I went to Pittsburgh, Pennsylvania. My fiance at the time got accepted to grad school there. And so we moved to Pittsburgh, and I was very fortunate to find a job, even though it was in Atlanta at the time. I found a job at Shire Downs, and that was doing mostly internal audit stuff and some financial statement audits. But really it was doing SOX, like Sarbanes-Oxley's internal audit testing for some clients, SOC reports and internal audit reports. Yeah, and then so after a couple of years up there, long story short, personal reasons, moved back home to Albany. I love it down here in Georgia. From here, born and raised. So for me, it made sense to come back home. And I was very fortunate. Two of the first calls I made were to Dr. Bishop and Professor Robinson. I don't know if she was here whenever any of y'all were here, but because I stayed in touch, I reached out to them and I said, I'm looking to come back home. You know, do you have any insights on where I might be able to find a job? And they gave recommendations for obviously Jackson Tucker, Malden Jenkins, and Hutchins Cunningham Ramsey Huckabee, which was a smaller firm that focused on financial institutions. And we did internal audit and financial statement audit. And all those guys pretty much came from Malden and Jenkins. So it was a really great place to work. I stayed there for a couple of years. And then at dinner one day, I ran into my buddy who I played baseball with here at GSW. His name is Les Cromer. And he said, man, we need help in the accounting side of things. You ought to come work with us. At the time, it was AET Group. And he had 3 companies basically that, well, there were 5 business units and 3 of those I was the controller for. And he worked on the other 2. And basically 2 weeks after I started there, we got an LOI to be acquired by EIS Holdings. So EIS Holdings is a private equity held portfolio company. And one of the things that they really liked about AET Group, obviously the business is the first thing, but they liked that we had a lot of accounting horsepower. And so because Les is also a CPA, he started in the governmental Georgia Department of Audits, but he's also CPA. And so they really liked that, and being a little bit gun shy about that, we just got acquired. They didn't really communicate what the plan was for all these accounting people. I started looking for jobs elsewhere, and then I accepted a job elsewhere, and they said, wait, we don't want you to leave. So now I work for EIS Holdings, and I do M&A. I help with due diligence whenever we're looking to acquire a company, help with integration, and right now I do a lot of the controller, bookkeeping, accounting type work for one of the brands that was acquired in 2022. Yeah, and the other thing, I put a bullet point there, but I do travel quite a bit. I work remotely out of Albany, but our headquarters is in Dallas. So thanks for being flexible. This was originally scheduled for Wednesday, but I leave tonight to go to Dallas. So I travel more than my wife would like for me to. Do you have some water?
Of course, yep.
So yeah, one of the things that I was asked to speak about was a day in the life. You can't really see it very well, but you see how many meetings I have. But basically this morning, I had an 8 a.m. check-in with my boss. That's kind of why I was late, because it ran a little bit longer. And we're working on consolidating and reconciling WIP reports. You know, it's just another task that goes into accounting, right? Making sure that everything ties to the balance sheet, and making sure that our reports are calculated the way that they need to be. So then I came here, there's a PMO consulting call. And again, feel free to interrupt if you have any questions.
Okay, so this is what I find interesting. So you said you had a letter of intent. Okay, so that was an abbreviation.
An LOI. So did
LOI, right? And so you said you had an EOM, something or other, right? Did you say? What was that?
No, so
Okay.
we got an LOI, and then
Yeah.
we have the
Oh, when you were talking about the calendar. You were talking,
Oh,
you had some
EOM.
other, yeah,
in a month.
end of month. Okay, so there's just some abbreviations
Yeah,
that
sorry.
might be,
Yeah, if I
And so what is a
PMO, yeah, the
Okay.
Project Management Office. And so
Okay.
that's a new thing. Our COO kind of implemented that, but basically we have two basically service lines that are within EIS. So there's the larger projects groups that do remediation, industrial remediation, demolition type stuff. And they're all calculated, their revenue is all calculated on percentage of completion, right? And then you have the consulting group, that's two of our business units, and they're calculated basically as the work is performed, not on POC, but whenever it's billed. And the consulting group, we have initiatives, right? So I'll kind of get into what it means to be a private equity held company, but some of the big stuff is they want to drive value growth. You know, how do you do that? And so during the consulting PMO, we'll talk about our top 5 initiatives, which are like cross-selling, margin improvement, that kind of stuff, and how we can implement these initiatives to make the business more valuable.
How big is your company? You're mostly in Dallas?
Mostly in Dallas, yeah. We have brands all over. Denver, I go to Denver quite a bit too. Dallas, Denver, Georgia, Florida, right outside of DC. We have about 1,100 employees, and we're going to do about 200 million in revenue this year.
So how many of you are in Albany? Is there an Albany office, or is it just that you're in Albany and you mostly work from Dallas?
Yeah, no, that's a good question. It's because AET Group was headquartered in Albany, everybody's still there. So there's probably 8 to 10 office people in Albany, and then we have technicians and stuff that are based in Albany, Warner Robins, Valdosta, a lot in Florida. I think we have just AET Group has 3 or 4 offices down in Florida.
How often do y'all all get together? Do you have like an annual company? You know, like a lot of companies that have a lot of remote employees have like a week of a year to all get together or something like that.
Yeah, we have the shared vision meeting in January. This will be the second one. And it's not everybody though. It's basically the leaders that get together to go over the initiatives, to go over the certain, like what we want to achieve in the following year, basically. But all together, I don't think we've ever had a meeting for everybody. So each brand has a controller. And so there's, I think, 6 controllers, including myself, 7 if you include the corporate controller. And we have been meeting, so I got a new boss basically May or June. And he believes getting everybody together in Dallas, or all the controllers and finance people together, is helpful. And it really has been. So a couple of things we've achieved just this year based on those meetings is we went from like an 18-day close cycle to a 5-day close. That was a big priority.
What does that mean, 18-day close cycle? Can you
Yeah,
tell
so
them with that, going from 18 days to 5 days?
well, I mean, all right, let me talk about close first. So the close is you basically want to lock down your books, and then you want to reconcile your balance sheet stuff, right? And report the numbers based on, you know, how the month went. And we were taking almost 3 weeks to do it because they were waiting on a lot of stuff to come in instead, like expenses, right? Instead of accruing for it. And because there are a lot of the business units that are percentage of completion, it like their revenue is driven off of the expenses. Does that make sense? Does everybody get that? So if you have a contract for $1,000, but your cost budget is $500, if you spend 250 of that $500, you can recognize 50% of the percentage of revenue, right? So you'd recognize 500. So they were waiting for all their expenses to come in instead of making an estimate. And basically you're giving up some precision for timeliness. So we shortened all that down, made more accruals, made payroll accruals that drive revenue as well. Does that make sense to everybody? Does anybody not understand that? Did I explain that well enough?
Yes.
I feel like. And one other thing about the close cycle is instead of taking up 2/3 of the month, it only takes the 5 days. So you have a lot more time to drop the other initiatives. And that was a big thing for new CFO.
What are you doing with those 13 days now that you got back?
I don't do anything.
But
No.
I guess what I'm asking is why is it important to have can you explain why it's important to have the close faster?
Yeah, absolutely. And so the other initiatives that we've been working on through the meetings in Dallas with all the finance people. So cash flow is essential, right? Cash flow is it's incredibly important. It's almost as important as income, right? Because we're highly leveraged. We're private equity owned, which means that most of the time private equity owned portfolio companies are required with leverage buyouts, and leverage means debt. So we have a lot of debt on the balance sheet. We have to increase our cash collection cycle to be able to pay down the debt and also keep up with our other bills. So we've been focusing on our DSO. Does anybody know what DSO means? Days sales outstanding. It's basically like how long your cash conversion cycle takes. So ours is somewhere around 100, depending on the month. And we're trying to get that down to 60, right? So that would mean that we'd be able to save 40 days DSO, and our cash would turn over a lot quicker, and we'd have a lot more capital to pay down our debt or to buy fixed assets, whatever it is. And then also for the controllers to be able to focus on their projects and be able to say, like, these projects aren't doing as well. They have more time for that, and to be able to work with the project managers to, bring those projects back up to par, to standard. I have a lot more here. And what time do I need to be done?
It's like 10:45-ish.
Okay, all right, yeah, we're good. So anyway, so fixed assets, so we're implementing a new fixed asset software process. I have a call with them tomorrow. The ops call, this is a monthly call. And then you can't really see it, but on Friday, there's an AR and WIP call for one of the business units, the one in Colorado that I'm acting as controller for.
So you want to say what WIP is?
Yeah, work in progress, right? So for them, it's all of their project, like I mentioned, there's 2 business lines. They're on the consulting, so they accrue revenue based on man hours, right? Or whatever their expenses are, but the revenue is accrued not based on a project budget. But anyway, so they have a lot of hours into a project. Their WIP builds up, and it's basically an asset on the balance sheet until you bill it, and then it goes to AR, right? Does that make sense, everybody?
You're just trying to keep things moving.
Right.
Make sure everybody's.
And that goes back to the DSO, right? We were trying to increase our cash collection cycle. Yeah, this is another thing you guys may talk about in the software usage. So yeah, this morning we spent all day in Excel, or all morning in Excel, running pivot tables, trying to understand why these 2 reports aren't tying, right? And then we're trying to get into the details of that and understand. But yeah, at Shiner Downs, I used IDEA. We did analysis, analytics, and use it to sample to get true random samples. Profix is what we're doing now, and that'll be actually tomorrow and Wednesday. I'll learn a lot more about that, but that's the FP&A, which is financial planning and analysis tool. That kind of goes back to more the finance rather than accounting, to be able to drive changes and drive behaviors that you want to see with that. Like I mentioned, I'm in Excel all the time, always in Excel. VLOOKUPs are important. XLOOKUPs, do y'all know how to do VLOOKUPs?
Yeah.
Really? That was awesome, because I don't think I did in college. That was something that whenever I started at the CPA firm, your buddy next to you had to explain it to you. So,
We're just taking systems now or in the spring or, yeah, we'll do lots and lots of that. Systems.
VLOOKUPs are awesome. Pivot tables are great. Index match is supposedly better, but I can't do it. I'm sure I could if I sat down trying to figure it out. And ChatGPT, I mean, I use ChatGPT all the time. If I can't figure out a formula, I'll type it in there and like, how do I get this, result? And it'll tell you step by step. So ChatGPT is really an awesome tool. That's something that Dr. Bishop and I talked about on the phone quite a while ago. Is, do you think that like AI is going to interfere with the accounting profession? Does anybody have an opinion on that?
Yes. I think it will.
In a good way or bad way or indifferent?
I think maybe in the future, a couple people might be out of jobs, like depending on what kind of software there is, but I think it's a good tool just to, like, as you said, bounce ideas off.
I don't disagree with you. I think once it's implemented and it's, it's embedded into like QuickBooks, then it'll make it a lot easier. You'll be able to upload transactions, whatever. But I think that in theory and hopefully in reality, will free up more of our time to be able to focus on where we can add more value. So one of the things that I read, I think in a textbook a long, long time ago was whenever computers were starting to be used in the profession, it actually freed up more of the accountant's time to be able to focus on value-added processes, and billable hours actually went up compared to before, whenever everybody was doing everything on paper. And I'm hopeful that we'll see a similar change whenever AI gets more embedded into these softwares. But I do think it's a great tool, and if you're on the front end of it and you're staying ahead and you're using it in the way that, in a way that adds value to the company, you're going to be indispensable.
I disagree. You need to keep that in mind. Yeah.
So these are all coming in one by one. Anybody know what EBITDA is? Earnings before interest, taxes, depreciation, and amortization. And that's basically what EBITDA is, what we're measured against, right? We're not measured on net income because we are highly leveraged. Our net income would be way less than what it is because you have to add in interest. So like I mentioned, I think I can say this. This is being published on YouTube.
It is, yeah.
We're in like 9 figures of debt, right? So you think about that, and you think about what the interest rates have done over the last year. That significantly increases our debt burden.
That doesn't necessarily mean that you're doing bad though, right? So when we talk about ratios, we always say, is this a good ratio or a bad ratio? And my little catchphrase is it depends.
Yeah.
So compared to other equity companies, that's probably about what it's supposed to be.
Exactly right. So I think we've seen M&A slow down, mergers and acquisitions have slowed down because of how much the interest rates have gone up. But no, we're not out of line from where I think our peers are in private equity held portfolio companies. But that's what I mentioned too, is your cash is so important because you do have 12.5% interest on that amount of debt. It really adds up quickly. Anybody know the chair of the Federal Reserve is? Come on, somebody knows. Jay Powell. Anybody know why he's important? Somebody answer, come on.
I'm sorry, did you say Jay Powell?
Yeah.
Yeah, he's the Federal Reserve Chair.
Yeah.
His breath can move a market in one of 2 directions, depending on what your flavor is in terms of what you need.
Yeah, exactly. And what does he influence, right?
Interest rates.
There you go. So he's determining the federal funds target rate, which is essentially the interest rates. And anybody know what the balance is he's trying to find?
2% target.
For inflation, right? So that's what they've always said, the inflation target is 2%. And as we all know, inflation has been ridiculous the past year and a half, which is why he's been increasing the rate so much. So yeah, the balance is inflation and economic well-being. Anybody know what SOFR is? or LIBOR. Anybody remember what LIBOR was? SOFR is basically the replacement for LIBOR. LIBOR was the London Interbank Offering Rate, right? Which was what everybody based their contracts off of. It was like your contract would be your percentage, your interest rate is LIBOR plus X basis points or whatever. And SOFR is the replacement for that because there was collusion taking place, I think, in London whenever they were doing LIBOR. Anybody know what like the target rate would be right now? Does anybody know what the mortgage interest rates are right now? Something like 8%. SOFR is 5.3. And that's, yeah, it was 0.01 in January. So there's a chart really quick that goes over how, so whenever we first got acquired, it was May of 2022. And you can see the interest rates were, you know, and ours is plus 7.5%. So you can do the math on that.
Can I interrupt 1 second? It strikes me that when you were sitting here in a classroom, you might not have known the
Oh,
answers to some
absolutely
of
not.
these
Yeah. Don't feel bad. I wouldn't have known either.
Okay, so how did you learn all this stuff? I talked to somebody over the weekend and she was going to take a new job that she didn't know really much about. Well, how do you learn something about something you don't know anything about?
I continued to read a lot of books. Whenever we first got acquired by a private equity company, dug into every book I could find and every podcast I could find. And there were some really good books that I read that kind of covered what it meant to be acquired and like what the different types of acquisitions were, financial versus strategic, which is like if for financial acquisition, it would be by another private equity company. Or if it was a strategic, it would be by like basically a public company that wanted to roll you up under their systems and, you know, go off the synergies of the acquisition. But anyway, so it was just all about reading books. I read a lot of books.
They weren't assigned to you. You just read them because
Yeah,
you needed to learn something.
Yeah. A little bit nerdy, but I did buy
Yeah.
a couple of textbooks
Yeah.
for like master's programs and just read through them and picked out what I thought was relevant for me.
Yeah. Favorite podcast now?
There's M&A Science, which is really interesting, and there's Private Equity Fast Pitch. And those two are, I mean, I listen to those on planes every week pretty much. And it helps because if you listen to the podcast, you pick up the lingo and you sound smarter than you really are. So that's where I'm at right now.
Great.
So one more thing.
Yeah.
I sit at the Georgia game next to a guy he's a CPA with a firm in Atlanta, a fairly big firm. They were just bought out by private equity a year ago.
Yeah.
And I had never heard this.
Yeah.
That a CPA firm would be bought out.
That's it. Yeah, I actually heard that recently too. So the reason for that is they like low CapEx because they don't want to spend all of their free cash flow on capital, which would be like, you know, fixed assets, buildings and stuff, or heavy equipment. Like we have a lot of heavy equipment, and they like that because it's recurring revenue. That's really important for private equity. They like the recurring revenue. The margins are consistent. I don't know. It's interesting that they are diving more into that.
And what they're looking for is that you grow your business by like 5x to get to a different size. Is that what they're looking for in you too?
Exactly, yeah. So we're currently in the budgeting process, right, for 2024. And yeah, they want to grow us from, our revenue this year is going to be about 185 million. We want to be at, you know, I wonder how much of this I'm really allowed to say, but we want to be like 15% growth, basically. And there's certain areas that we want to focus more of our growth on, and that's the higher margin stuff. But yeah, it's really interesting that private equity is getting into CPA firms, especially because there's a lot of older CPA firms that didn't do a good job of succession planning. So I wonder if there's an opportunity there, but to me, I think it probably lose some value.
We maybe just kind of jumped into, like, can you just go really big picture on what a private equity firm does? Like,
Yeah.
So just,
Yeah, there's a couple. All right, so there's an LP and a GP. It's a LP is a limited partner, and basically that's your investor. So you think of endowment funds; those are a lot of the investors, and also public pension funds. And so they invest in these funds, that are private equity started, right? So they're private equity. We're owned by Sun Capital, like Sun Capital Partners or something like that. But Sun Capital gives and they start a fund, they raise money for it. They're going to raise $200 million. And with that $200 million, they're going to buy 10 portfolio companies and they're going to build them up through other M&A. So there's the LP, which is the investor, and the GP, which would be the general partner, which is Sun Capital. And they take the money that they raise from everybody. So they're going to buy a $100 million company. They'll put in 40 million, and then they'll use debt to cover the other 60 million. Was that?
Yeah, I think, and so you buy these companies up, and then what?
Yeah,
You consult with them to help them grow, and then you sell them, or you keep owning them, or what?
Yeah, that's another good point. Yeah, so they're not holding on to them indefinitely because basically whenever you invest in a private equity fund, your money is locked. You can't withdraw it the same way you can withdraw your money out of a publicly traded company. So like Ford, if I wanted to sell my stock in Ford today, I know what I can get for it. It's a little bit more gray with private equity funds. And so they're trying to continuously, and the life of these funds are usually, I think, like 10 years. So within the 10 years, they buy companies, they build them up, and then they sell them for, and they're trying to get an internal rate of return, which is basically what your percentage of return would be every year.
So rather than buying and selling stocks, y'all are buying and selling whole companies, basically.
Right. Sun Capital bought us.
Yeah.
And so they're going to sell us in a couple of years probably. And hopefully, if they invested, call it 50 million, hopefully they get back 200 million.
It's kind of like a house flip.
Exactly. Yeah. And I have an example later. We're still pretty good on time. Let's get up a little bit. Anyway, yeah, higher interest rate has on business, so makes it, for us, highly leveraged. It makes it more difficult to use our free cash flow on anything but interest, right? It drives down valuations because your hurdle rate is a little bit higher. So if you can go and get 5% risk-free from a treasury bill, it makes it harder to. Does that make sense, everybody? Does everybody understand that? The leverage ratio that we go off of, it's debt divided by EBITDA. Oh yeah, this is a good one. What? Oh dang it! I already put up the answer, but your interest is a big drain, and then CapEx. That's a big one. Nah, you can leave it up there. CapEx is a big one because it's included in depreciation. But if you think about it, where does CapEx flow through? It doesn't flow through your income statement, so therefore it's not reflected on EBITDA. And whenever you buy an asset, that's still a real use of funds, right? That's still a real use of capital. And yeah, maybe taxes depending on the company. Anybody know what arbitrage is? It's whenever like the currency, for example, is valued higher in one market than it is a different market. So you buy it over here and you sell it over there. And you're basically just picking up on that little bit of a difference between the two. So the reason I mention that is because certain companies are valued higher than other companies. We're, like I said, like a $200 million company. Our multiple is, just call it 10%. If we can go and buy another company and roll it up under our, basically like what we already have, and we can buy another company for 5 times, we buy them for 10 million. Well, they're already valued as soon as they're integrated into our processes and into our company. They're valued at 10 times. So if we buy them for 10 million, they're valued at 20 million. That's a little bit of the arbitrage, and that's an area where private equity really likes to try to build value, is buying companies and rolling them into a bigger company that's valued higher. You might know what it means to be publicly traded. I kind of touched on this earlier.
They have a higher
Everybody should be
chance.
nodding here. It's like, yeah, they should know this for sure.
And then private company. And then what are the pros and cons of both? So anybody have any opinions on this?
Yeah, mining from kind of like anywhere with a public traded company, but you gotta be like, be recognized by SEC, make sure you're following all those rules and stuff like that.
Regulation is a big one, yeah. Yeah, it's you have a lot more regulations. Anybody else? Anything else? So for private companies, there's less scrutiny because they're not making all these public filings like, quarterly filings that public companies have to. I think I gave some good answers. Yeah, transparency evaluation for public. Like I mentioned, Ford, what the stock is right now, you can look it up and it's probably like $13 or whatever. Versus if you own a private company, you don't know what it's valued at until you go to sell it. And you have some negotiations and that kind of thing. So yeah, we're performing a roll-up, like I mentioned. We're buying companies that are smaller and tucking them in, integrating them into our systems. So if we're highly leveraged, how do we create more equity value? If our enterprise value, or if our equity value equals enterprise value minus debt, what do? We pay down debt. So we're trying to take all of our possible free cash flow, pay down debt, while also running a valuable business and profitable business. Part of that goes into expanding multiples, like I mentioned, expanding where our margins are the highest. So a company that has higher margins and on a weighted average basis, if we can, influence that to get it higher because of our focus on higher margin areas, then we're going to be valued higher. Here's my contact info. I do have an Excel example, but does anybody have any questions? I know it's kind of a lot. It's kind of a crash course in private equity and finance.
How long does it take for one of your M&A transactions to go through from like somebody has an idea versus to close?
That's a good question. So usually we want warm leads, which are companies we already do business with or we know of because they're in a similar market, and we can do a warm introduction. But we have an M&A team, which is his name is Tyler, and we have a chief growth officer, chief investment officer. And so those two travel to go meet all these companies. And from the time we meet them, we get to know them. The LOI could be a month out from first introduction. And so the letter of intent is like, basically it's non-committal. It says, we're interested in acquiring you at this price, but it's not a contract. It just says we're interested. And so from that, then we go through due diligence. And also part of the LOI is like exclusivity. So a lot of people reference this like dating. You date for a while before you get married, and the marriage is the purchase. So part of the dating is doing due diligence, and that basically means in-depth audits of all of their financials. But that whole process can take a while. Whenever AET Group got acquired, I think we did it in 58 days from LOI to SPA, the purchase agreement, and that was record time. That was me and Les were killing it. Weekends, we were working a lot. We were going ourselves to get it done, but I mean, that was atypical. I would say usually it's probably 3 months or more. But M&A for us is slowed down because of interest rates, right? We got to focus on driving down our debt so we can increase our capital that we can use for other stuff. Does it make sense? Does anybody have any questions? I feel like I'm just talking to myself.
So when you buy the company, are you guys like trying to help them make more money under you?
Yeah.
Is that what you're doing?
Yeah, absolutely.
Okay.
Yeah. The company we acquired in Denver, so we acquired them September 30th of 2022. And they went from a company that was doing on average 600 to 700,000 in revenue to now they're doing about $1 million in revenue. And their EBITDA margins are consistently 30 to 35%, which is really good. So if we can continue to grow their revenue, all of that's pretty much flowing into the bottom line for them. But for that owner, the owner that sold, really, really great guy. And for him, the opportunity was to, they says, to take some chips off the table, right? So he's able to sell and he's able to take his X millions or whatever it is. And basically he leaves some investment in the company. And that way everybody has shared interest in seeing it be successful. So he wants to see it grow too. But for him, the big thing was to be able to not have that liability. If something terrible happened, whatever, he was interested in being able to step back, spend more time traveling maybe, But for him, at least, it's been a really successful exit because he's been able to step back, be able to see it grow. He's still heavily involved in it, but for him, I don't know, it's been successful. Did that answer your question?
Yeah. Can we see your Excel spreadsheet?
Yeah, absolutely.
Because, to be a nerd.
Let's see that, yeah. So this is the internal rate of return calculation. But year one, let's say they acquire a company for, you can see the numbers in column C, right, the original. So the valuation is 9 times EBITDA of 110 million, so the total enterprise value is 990 million. They use debt of 550 million, so that means that what they have to put in as equity is 440 million. Does that make sense, everybody? So that's in B3. That's their initial expense or their initial capital allocation. So then let's say they don't do anything for years 2, 3, 4. If they sell it in year 5 for 1.2 billion, how do they get to that? So it's the valuation. They increase the multiple because they're a better managed business. They're better ran. They have better processes, better margins, maybe whatever it is. There's a lot of things that they value the company on. And a lot of that is storytelling, right? Like you want to be able to tell your story and explain why you are valued at 10 times versus 9 times. And then you have your EBITDA increase from 110 million to 150 million. And then you pay down 250 million in debt using your free cash flows. There you go. Yep. And so that would give you an internal rate of return of 28.5%. And that would be like, I don't know if it's a superior return, you know? How many of our investments are getting 28.5%? Not many. Most of the time I think the market increases like 5-7% a year, something like that. So that's the whole value proposition behind private equity. Does that make sense?
Are you a partner or an employee or
I'm
part
an
owner?
employee. No, wish.
Okay.
That's a good question because in private equity, one of the things that they do is they try to incentivize you with equity. And so if we exit, you know, and have a really successful exit, a lot of that equity does flow down to the employees. And that's where it can be really, really rewarding. So.
A lot of our students are planning to start in public accounting, but maybe not stay in public accounting forever. So can you talk a little bit about that transition time from when you were in public accounting to where you got this idea to move to?
Yeah, like I mentioned, it was because they're in into less at dinner, and then whenever I started there, within a few weeks we got acquired. But that really opened up a new world for me because whenever we got acquired, and I was like unsure of what they were going to do with all the accounting people that we had, I started looking for jobs in private equity because I think it's really, really interesting what they can do. And there's a lot of money in private equity. It's kind of dried up a little bit because interest rates are going up, but there's a lot of money in private equity. And for me to be able to work remote, so the job I accepted was based out of San Francisco, but I was going to work remote from Holland, Petersburg. So to me, that was really interesting. But public accounting is definitely, I wouldn't say definitely, public accounting is a great way to start your career. You learn a lot. You work and get that, but you learn a lot, and you're able to touch a lot of different clients. And learn a lot of different industries.
Do you think that starting in public accounting has helped you in private equity?
Yeah, absolutely. And a lot of this is finance driven, but that all stems from the accounting knowledge. You know, accounting is the backbone of everything you do in finance. And so for me, I think it's really interesting that there's been a downtick in accounting students and an uptick in finance because I think that they go hand in hand. And if you have the accounting knowledge, you can do any of the finance stuff. So getting a background in public accounting is definitely worth it. And if you look at job postings, a lot of them are looking for people that started in public accounting. But I think that, so I was thinking about this on the drive over. There's really 3 main places you can go for graduation, right? It's like governmental, public, or industry. which would be like where I'm at now. I work for a company. I don't do audits anymore. And really, I think any of them are a good place to start. I don't think there's a bad option because Les started in governmental. He started at the Georgia Department of Audits. And then he worked his way to be a CFO of this company at AT Group. So as long as you're working hard and you're continuously learning, I think is the biggest part of it, right? You never stop learning and you'll be okay. Any other questions? I enjoyed GSW, so I hope y'all are enjoying it too. Are y'all all sophomores, juniors, seniors? Seniors? So do y'all have, so she mentioned y'all are going public, some of y'all are going to public accounting afterwards. Where at? Somebody, come on.
I'm going to Draft and Tucker.
Draft and Tucker, they stink. I'm just kidding. Draft and Tucker, they're great.
How many of y'all had
You know,
internships so far? Or have internships or job offers, or Maddie went to a leadership program?
I have an internship this summer with Draft and Tucker.
That's awesome. Y'all know Jeff, right?
Yes.
Yeah, he's a great guy.
We've got some other Draft and Tucker.
Yeah, Lily works
Lily.
there.
You work there? That's awesome. A lot of my friends are managers at Draft and Tucker. The other thing, yeah, it kind of goes back. I'm close to a lot of those people through, like you mentioned, the Artesian City Sertoma Club. But yeah, if y'all plan on standing around Albany or whatever, join Junior League or something, or Sertoma or Rotary or Cooperative, whatever it is. It gives you an opportunity to stay connected with people that you can grow in your careers with.
And that's a really good point. Chase is really good about staying connected. A lot of people do stay connected years after they graduate. And like I was saying, one student asked me for advice on a job offer, what should she go back for when they offered her this much money? What should I do if I have this chance to go over here? And when you stay connected with, your professors and the people you go to school with, you're going to have like 10 times as much opportunity as somebody that's just in a hole off by themselves.
Yeah, and the ability to ask questions and bounce ideas off somebody is
Right.
hugely helpful. Whenever I took the other job offer, our CFO at the time, he was the one that asked me to stay, and I was like, "Look, I'll stay, but I want to mentor. I want you to be my mentor. I want to learn from you." He's since left the company, but we stay in touch. We still have weekly meetings, and now to have a mentor that's outside the company is almost even more helpful because I can ask him candid questions about stuff like that. I wouldn't ask him like if I should take this other job or interview somewhere else if he was still at the company. So yeah, stay connected, and to have friends that are like managers at Draft and Tucker or whatever, that's also huge because you can kind of compare where you're at in your careers and see what somebody's done right or whatever. Anything else? Anybody have internships or job offers for Malden Jenkins?
Might have one the following summer.
The following
I'm
summer?
like talking on the phone with somebody right now.
Emma raised her hand too. Internship or leadership?
I have an internship next semester there.
That's awesome. Yeah, those are both great firms. Draft and Tucker, from what I remember, they do mostly hospital audits, right? And then Malden Jenkins is mostly financial institutions, and yeah, I don't know, they're both great. I interviewed at Draft and Tucker, but I didn't want to go to hospitals all the time for personal reasons at the time. So I made a different decision, but I think it's all worked out. But everybody I talked to at Draft and Tucker and all my friends that work there are great people. So, all right.
Thank you so much.
Yep, thanks.
Thank you.